Thumb up. Did anybody hear that but me? Are we good? Okay. So what we're seeing here is that this is chapter 6, but the very first word is really chapter 7. We're going to spend 5 hours on the first word, control. And so what we're going to see in chapter 6 relates to chapter 7. And what we saw in chapter 7 will relate to other chapters. So all accounting is kind of connected. There's a connection between chapters 1, 2, 3, and 4, because 4 connects with chapters 1 and 2. And next thing you know, 3 is also part of that. So you really can't talk about an isolated chapter without bringing in other chapters, even the chapters that we haven't even taught yet. And so here we are, we're talking about inventory, and there's the control of inventory. So we're going to see that in an entire chapter, 5 hours of what instead of 5 minutes here. And so basically the control over inventory, it involves safeguarding inventory from damage or theft. So that means you lock it up. Okay, how do you keep people from stealing it, from having it grow legs and run away? The next one down here is reporting inventory. Now, in chapter 5, we gave you numbers. And what's the inventory? And we just gave you a number and you plugged it in the balance sheet. We thought, oh, cool. Well, today we're going to learn how they come up with those numbers. And I've got some scary news for you. You want to pay attention because there's going to be at least 6 or 7 numbers that you can generate for the value of inventory, and they're all different and they're all accurate. So I'll say that again. You're going to see today's lesson, we are going to learn that how accountants value inventory can vary. And there's different techniques, different things that you're going to learn about. And so our balance sheet, the inventory that's on the balance sheet, will have a different answer 6 times. You only get to pick one. So the obvious question is, well, which one should I pick? And that's what you're here to learn. We're going to show you the different strategies, the different things. And again, this is 101A. We don't really get into the full details until you take more accounting down the road. But for now, we're going to keep it simple for the students. We're going to come up with the 6 most common ways that calculate the inventory. There's 7, but here's the good news. There's going to be one of the ways that we do it, one technique, and then there's the other technique. One of each of those ways overlap. So instead of having 7 ways, there's really 6 in this book. And I'll show you when I turn the page in. The first page says, control for safeguarding inventory begin at the very, very beginning, as soon as you order it. Because I can't decide, I need new computers for my classroom and order them. That doesn't work that way. I have to fill out a purchase requisition that my principal signs, and then he ships that if they agree, and I have money. I mean, I raised money, and I did that for years. I think I bought, I don't know, was it 10? Or sometimes I bought 2 of them. I mean, 5 years later, I bought more. I changed the computers. I probably bought at least 10 computer labs over the course with just writing grants. And so we had some of the most advanced computers at the high school level, and we had more computer labs than anybody else had before the district started to support it. But we had 7 or 8 computer labs when most schools had 1, mid 7 or 8. And so the purchase order is what happens after I tell the principal, hey, I got the money, I got a grant, can I order new computers? They go, sure. So then they submit a purchase order to the purchasing department. And so then they order it, and then it shows up, and so there has to be a receiver report. And then after that, there's a vendor's invoice. So all these things are going to be compared to make sure that what I ordered really came, because we're not going to pay for it unless we really ordered it and they actually delivered it. So the purchase order authorizes the purchase of inventory from the approved vendor, right? So as soon as inventory is received, you get a receiving report. Okay, so you make that, you complete that receiving report, you verify what you ordered showed up. So it establishes an initial record of the receipt of the inventory. So what did you order? What showed up, right? To make sure the inventory received is what was ordered, the receiving report will be compared to the purchase order. Because if you ordered 38 computers, you better get 38 computers. But if they don't all show up, that means they could be back ordered. Well, you got to keep track of it because you're not going to pay for something that you didn't get. Right? So the price, the quantity, and the description of the item on the purchase order are going to be compared with the vendor's invoice. So if the receiving report and the purchase order and the invoice all agree, awesome. You put them in the accounting records, you journalize it. And that's what we did before. So we assume that we purchased it and they arrived. So then we journalize it. But if there's any kind of discrepancy, any kind of difference, you have to investigate. Like, what happened? Is it because the shipping company lost it, and the company that sent it to us, they thought they put it on the truck, or is it an error because there was a back order? Maybe not an error, but they just deliver everything. So you got to figure out what happens so that you're only paying for what you ordered and what you received. So recording inventory using a perpetual inventory system is also a good means of control. Right? With perpetual, you have an idea of how many items you should have in your inventory. And we talked about having the subsidiary ledger, so you know how many, tires are left at Costco or batteries or whatever else they have. And this helps keep the inventory quantities at proper levels. Again, you don't want to have too much or too little. You want to have just the right amount. And we'll talk about that in chapter 7. Basically, just having the right amount, it keeps you from ordering too much inventory because it's bad. If you order too many things that are perishable, it could rot. Now you have inventory shrinkage, what we talked about last time. Or if it's a fashion item, you buy a bunch of winter coats. Well, right now it's March. It's going to be spring. And so if you bought a bunch of winter coats right now, you're not going to sell them. And the next year, you can't sell them because they're old. They are not the same style. So this is why you have to keep track of inventory. It's huge. So basically, you have to have more controls. So you have to have some controls for safeguarding these assets in that assets inventory, right? To prevent damage of customer or employee theft. Believe it or not, that's a real problem. And you'll see that Costco has things in place so that you don't, their stuff doesn't grow legs and run away. So number one, you're storing inventory in areas that are restricted to only authorized employees. So a lot of the inventory is not going to be out available. We're going to keep it out kind of under lock and key. And then you'll notice at Costco, they actually have the high priced items double locked. I mean, they're in the back room. So when I bought years ago, before I would download my tax software, you could go to Costco, and I still think they sell it with a CD, but they would sell empty boxes. So you're in the checkout line and you have an empty box. And then as soon as you paid for this empty box, you go stand in line behind a bigger closet that's double locked with a chain and the gate and the person in there, and you show them the empty box and you show them the receipt, and they give you the software that went inside. So that kept people, including employees, for taking the software home with them and whatever. So that's just a locking with high price. And they do that with jewelry and other things at a lot of the stores, right? You also use some other safety devices, two-way mirrors, cameras, security guards here. Costco does that. As you walk out the door, you have to show them the receipt, and they kind of put a happy face on it, whether they do at Costco. But you can kind of see what's going on. So the next thing is to talk about reporting inventory, and this is where it gets interesting. So if you're distracted now, this is the time to shine. You got to wake up, because this is the real deal. We're going to talk about how do we put the amount of inventory on my balance sheet. How do we report it? And so this is where it gets interesting, because number one, you took a physical count. That's what we did last chapter. So the physical inventory should be taken at the very end of the year to make sure that the amount of inventory that's on your balance sheet is accurate. So whatever you put on your balance sheet for the public to see has to be the truth. And so after the quantity of the inventory is determined, what you have to do, you have to come up with a cost of the inventory. So you know how many quantity is left. I got 85 of these things. Well, what's the cost? So you have to assign it a special cost for the financial statements. And so how do they do that? Well, we have a problem. Because if you have been paying attention, gas prices have been going up the last couple. So that's inventory, right? So gasoline used to be $2 and I don't know, 60, 80 cents, and now it's over $3. Well, that inventory value is changing, because now when you buy more gasoline, and Costco buys more gasoline from their supplier, that price gets dumped into that gas gets mixed up with the existing inventory that only costs $2 a gallon. Now they're paying $3 wholesale or whatever. I'm just making these numbers up. I don't have an accurate number. So we have a problem. How do we know what the value of that inventory? Because gas is gas, right? Or let's go back to canned goods. I mean, isn't a can of refried beans or baked beans or lima beans or green beans or whatever you get a can of beans? Aren't they the same? They don't change. We're not talking about somehow uh, difference. There's canned goods are canned goods. And so we have a problem. So accountants have come up with 3 inventory cost flow assumptions, right? Because when you get this can of beans that looks the same, the next time you buy it, it might be a different price, but it's the same can. And so you can imagine even computers have this problem. Again, when my son was really small, I would take him to school, and he had a year-round school, so he'd come to school with me. He's 5 years old, and he'd help fix computers. And so he grew up fixing computers. So when he got to be older, he goes, "Dad, I want to make a computer." And the first thing I said, "No way, that's not going to work." So he wanted to make a computer, and when he got older, he actually bought a bunch of components, and we made a computer. But the thing you know about computer components is that whatever is cool this very minute, 6 months from now, it's not going to be brand new cool anymore. And so whatever he got that was really nifty at that time, well, 6 months later, that same item is worth less. Not worthless, but it's just because a new item that came out, a new hard drive or a new video board or a new, whatever that came out, a CPU, all those things change. And so here you are at Fry's, and you have 2 identical items, and one just is a little bit older, so it costs more, and the newer one that you just got to replenish your stock is a lot cheaper. So what do? How do you know what the value of the inventory is when you have different prices? And so we come up with these cost flow assumptions. All right, so here we go. This is where it gets fun. We have an issue now because we have identical units of merchandise that we've acquired, but the value of the inventory, the price that we pay for each of those items is not the same. Now, if it's the same, there's no change. There's no chance. There's no problem because, hey, the gas was $2 and we bought more gas at $2, so it's $2. That's just the cost of the gas. You count how many gallons of gas you have still in your storage tank, and you multiply by $2, and that's the value. Simple. But what if it goes up and down, up and down? Well, we've got a problem here. So we have when identical units of merchandise are acquired at different unit costs during a period. In that case, when you sell an item, which one of those hard drives did you sell? You have a bunch of hard drives that you got early on that were super expensive, and they're the exact same box, the exact same material, the same everything, but yet the newer stuff is cheaper. So what do you know about that? Well, again, the cost of goods sold is taken away from the revenue, the sales price. And that cost of goods sold takes subtracted from what you charge for it, gives you your gross profit. So my gross profit has the potential of being different depending upon which item I sold. And so if my gross profit is different, that means my net income is different. And then also the balance sheet's messed up too. Not messed up, it's not wrong, it's just different. So when the item is sold, it's necessary to determine its cost using a cost flow assumption and the related inventory costing method. So what we have here is this really cool graphic. So here's my cost flow assumption. And so there's 3 things that you can look at. The cost flow could be viewed or seen as in the order in which the costs were incurred. Right? So in other words, whatever you got first is the stuff that, in the order. So that's the first stuff that you sold, maybe. Whereas in the middle, you could choose to, this is an assumption that you could choose to assume that, you know what, I'm going to assume I sold the newest one first. And the oldest one, I'm going to assume that I held on to. And the third option is just an average. So what's the average price? And so there are advantages and disadvantages to each of these things. So if we have some inventory that we get to select one of these 3 ways. The first way is called FIFO. Write that down. FIFO stands for first in, first out. So you got to speak like a local, it's FIFO. FIFO means that whatever was first purchased is assumed to be the first stuff sold. So if you look at this graphic here, it talks about a bunch of stuff falling into this box. It's not just a box, it's a business. So what's the first to come out the door is the stuff that came in first. The stuff that's just on the top of the box has to wait its turn, and it will go out when it's time. So this is called first in, first out. Now, I gotta tell you something really scary. So this is another chance. I gotta have you pay attention all night tonight. This is not an easy class. You have to pay attention all the time. This assumption is typically what happens in real life. Think about it. You buy a bunch of your grocery store, you buy a bunch of milk, right? Or bananas. Either way, anything that's perishable, it only makes sense to sell the stuff that you got a few days ago. Sell that before you sell the stuff that you just got today, the new, fresh stuff. Again, the bananas, it makes sense to sell the yellow bananas before you sell the green ones, because those yellow bananas turn black in a couple of days. So you don't want to hold on to those things. And so here it is. So listen carefully. The actual flow of merchandise does not have to match this assumption. I'll say it again. The actual flow of bananas, you're going to sell the old bananas first if you're smart. It does not have to match the assumption. You can pretend that the cost of the bananas that you have on your books is still the oldest stuff. But in reality, you sold the actual physical product, but your costs will remain on the books. So why would you want to do that? Well, that's why you're here in school. I'm going to be teaching you that. So pay attention. The other option is backwards, or at least the exact opposite. It's called LIFO. LIFO stands for last in, first out. And that means, well, the stuff that went in the box, the stuff at the top gets pulled out first. You say, well, why would you do that? Well, again, the actual flow of merchandise does not have to match the assumed flow. So I'm going to be showing you some exact examples right now of real life examples of FIFO, where the actual flow is FIFO, and I'm going to compare that with the actual flow is LIFO. Like, why would you do LIFO? How does that mean? The stuff that's at the bottom of the box, are you going to get a shovel and dig to the bottom here and find the old stuff? No, because you're assuming that you are going to sell the last in, the stuff on the top is first out. And again, in real life, you would really want to rotate your inventory or stock. You do want to sell your old stuff first. I mean, even canned goods will eventually go bad. So you don't want to have a bunch of canned tomatoes or canned peaches or whatever you had, canned salsa. At some point, those beans or whatever's in the can will expire. So you want to always sell the old stuff first. That's the actual flow of inventory. But the assumed flow can be backwards. So I mentioned before the bananas here. That's the actual flow would be first in, first out. So you get these bananas and you start selling them, and then you get a new shipment. Well, the new shipment is pretty much bright green. You don't want to sell the bright green ones until the yellowish ones or the yellow ones are gone. So once they're gone, then you open up the new shipment and you sell those greener ones. And that's what the FIFO looks like in an actual flow. But in reality, if it's an assumed flow, that's just how you're going to assume it. So we're going to do 3 demos today. The 3 demos is going to be FIFO, and then LIFO, and then we'll do the average cost. And that's going to be kind of an exciting part now. So let me give you an example of how come you would even think of it. Is there an actual flow of inventory that's last in, first out? Well, how could that be? Like if it's in the shelf, you just go by and dig and find it. Well, the example I always use is that many of you don't know, many of you weren't alive, and many of you can't remember that far back. On the corner of the 55 freeway and the 91, out there where Anaheim Hills come together with Placentia and Yorba Linda in that area. You know that, what's the tall building there in the corner of the 55 freeway and the 91? Anybody know that newer building, the tallest one right there in the corner? The hospital. Kaiser. Okay. Kaiser used to be on Lakeview down the road down to 91. I don't know if you know that. But anyway, they built a new hospital several years ago. So on that land where the new hospital is, wasn't dirt. It was a parking lot. Not just a parking lot, but who had that property before Kaiser? Well, if you go back 50 years or longer, it was a defense contractor. I think it was Rockwell. And they used to make rockets. And rockets are really heavy. So their parking lot was a cement parking lot. But a normal cement parking lot is a 3-inch slab. This was like a 12-inch slab of cement. You can't build a hospital on top of 12 inches of cement. So they had to jackhammer it all out with big machines And then, I don't know if you know this, but cement's valuable. Used cement can be sold. People like it for building materials, but you just can't sell chunks of cement. They have to grind it up. And so there was grinders. And again, they use this all the time. Even before that, the example I used was the 91 and 11th Street. Fullerton College is on 11. And so right on the 91 freeway, the 91 used to be 3 lanes each way. Well, they enlarged it. But the overcrossing, the 11th Street overcrossing, was only 3 lanes. It was cement. It was narrow. You couldn't expand. So they had to basically take out the overcrossing, the 11th Street Bridge, and put in a wider a structure. And so they basically put a bunch of plywood down. Hey, this is even before your time, but they did it up at UCLA. Remember they had Carmageddon or whatever they called it when they shut down the 405 several times because they're going to destroy an overcrossing. And they do this on a regular basis. So they put cement down. I said cement. And they put plywood down on top of the cement, and they essentially destroy the bridge. They kind of jackhammer it up and kind of blow it up, and it just falls down. And then since on the plywood, it doesn't damage the existing road bed, then they scoop it up and they can make a big mess and get it over with kind of quick. But what do they do with that cement? They resell it. They reuse it. They recycle it. It's very valuable. And if you've ever seen it, they haven't destroyed a bridge lately in Orange County that I can use as an example. But what they did with the Kaiser Hospital, they have these huge chunks. So they have to grind it up. So they have this industrial sized grinder that just like your ice maker at home that chews up the chunks of ice to make it into crushed ice. Well, they do that with cement. And so they got a pile of dirt. Well, you just can't have it. So what they would do is they get like a 5-story conveyor belt. And so it would grind up this stuff, cement, and it would go up the conveyor belt 5 stories up. Well, when it got to the top story, just a conveyor belt, like an escalator, right? It got to the top. Well, it stopped, and so it would so all the dirt the rocks would fall to the bottom. Now, if you were ever a kid and you ever went to the beach or played in the sandbox and you took a handful of sand and you drop it, and you take another handful of sand and you drop it and you do it, you know what happens if you do that multiple times? What happens to that pile of cement that's on the ground here? If you keep making a pile, do you agree that it kind of makes a cone? Give me a thumbs up if you're following my illustration. Does that make sense to you? You've got a little cone. The illustration is when you talk about last in, first out, when you start to get that material, the front loader, the scoop comes up, the big tractor with the front, it's called a front loader, comes up and it scoops the stuff. Well, the stuff that's scooping is not the stuff in the middle of the pile, it's the stuff on the outside. It's the last in is the first stuff out. Now, are they going to get a shovel and dig to the middle of that pile to find out that, well, it's gravel, it's not going to go bad. But they can assume that it's first in, first out if they wanted to, or they can assume that it's last in, last out. So the actual flow is going to be LIFO in that example because they're not going to spend the time and energy to dig to the middle of a bunch of rock to find out the older rock that's the same, that doesn't go bad even if it's underneath a bunch of rock. So that's what we're talking about as far as the FIFO and LIFO. The problem is that we're going to be talking about assumed flow. That's what it's talking about. That's the cost flow assumptions. The third one is the weighted cost. The weighted average cost here means it's an average, but it's weighted. And weighted means that if you have a whole bunch of one item, and then you add in 1 or 2 items of the other one, it doesn't really change that much. Like if you took one ice cube and put it in a bucket of a big bowl, a big cauldron, a big pot of soup, boiling soup, and you put one little ice cube in there, well, there's so much other hot stuff that little bit of didn't change the temperature that much. Maybe if you had a sensitive enough thermometer, it would register that it went down a little bit. But the reality is it didn't much. But if you have 50-50 of ice and hot soup, it will neutralize it. It will be somewhere in the middle. And so that's what we're going to see here as we go and we do some examples here. So here's illustration. Now, this is, again, I'm going to encourage you, pay close attention because this assumption down here is true for FIFO, LIFO, and weighted average cost. The assumption is you made 3 purchases. You have 1 unit, 1 unit, 1 unit. And the cost was $9 for that first unit, $13, and then $14. So we have rising costs here. And if you look carefully here, that we know that we bought 3 total units for a total of $36. You just add these 3 numbers up, it's $36. The problem comes is when you sell one of those three, which one of these identical units did you sell? The $9 one, the $13 one, or the $14 one? And it matters. And let me tell you why it matters. Because your cost, if you assume that you sold each of these things for 20 bucks, okay, that's what you're going to charge for. The cost of the goods sold for the first item is $9. Well, 9 from 20 means you have $11 gross profit. That's very different if you take 13 from 20, because you only have $7 gross profit. So I have changed my income statement just by assuming another item was sold, and I kept the other two. The third was 14. So now my gross profit could be either $6, $7, or $11. And here's the scary part. All three are accurate. The CPA makes the decision which one to use based on which assumption they are using. So the value of my inventory could change. Watch. Assume that at the end of the month you sold one of those units. It means you have two left, right? You have inventory of two items. What's the value of my inventory? Well, it depends. Did I sell this one, or this one? The other two are still around. So you can come down here and you can see that the gross profit changes or varies. So my gross profit is either 11, 7, or 6. I did this orally. Now you can see the picture. $20 is the revenue, the sales revenue. And then the cost of the goods that we sold in each scenario could be $9, could be $13, or could be 14. So my gross profit changes. The ending inventory is the combined total. So if I sold the 9, that means I have a $13 and a $14 one left. That's a $27 inventory on my balance sheet. That's very different than if I sold the $13 one, because that means I have a $9 and the 14. That's $23. And this is even worse. It's $22. So I hope by the time you're done watching this, you're going to see that the gross profit here is on your income statement. All three of those are accurate and they're at different numbers. And on my balance sheet, the ending inventory, the amount on my balance sheet could be three potentially different numbers. Right? You've got 27 inventories, or 23, or 22. Now you say, what's the difference? Only a couple bucks. Let's pretend it's in millions of dollars. 27 million versus 23 million versus 22 million. That's a bigger number to be concerned about. So we could solve that if we had the ability to track every item. And so we could use, I mentioned there's 6 types of inventory assumptions. We could have a 7th called specific identification. And that means you specifically identify each item. So if you had a way to barcode every bolt at Home Depot, so you knew which bolt was sold, you could do it that way. But the reality is, why? The bolts are the same, they don't change, and it's crazy amount of work to do that. For each bolt. Now, again, Home Depot does sell packages or boxes of hardware, so they do track that for sure, because it's already packaged. But when I go to my local Ace Hardware, they just have a drawer full of bolts, and I can pick out 2 or 6, whatever. So anyway, so if we have specific identification, each unit that's sold, it can be identified with a specific purchase. So we know exactly which one was sold, and you think, well, the ending inventory is made up with whatever's left on hand, so it's easy. So basically, the gross profit and the cost of goods sold and the ending inventory can vary. That's what we saw up here. And we can see that the cost of goods sold is 13 up here. In the middle, $13. That means the gross profit was 7. That means the ending inventory is 3. So depending upon which item is sold, you have 3 different numbers. Now, specific identification here is really not practical, as I tried to illustrate with the barcoding every item. That's not really something that's done very often. It's not practical. However, we could do that with cars. You see, if you go to the local dealer and you see this cute little white, pick any brand you like, Ford, Toyota, Honda, I don't care. So Toyota, you have a white Toyota with 4 black tires on it. Pick a model, doesn't matter. And right next to it is another white Toyota with 4 black tires. The same interior, everything's the same, but yet they're different. Well, how on earth can you identify 2 identical white Toyotas with 4 black tires? What was it called? Anybody know? How do you do that? Any takers? Even though they look the same, they're not. There's a way of identifying each vehicle. Boy, I get to teach you some more stuff in class today. Wow. So turn your brain on because here it comes. Cars can be identified specifically because they have something called a VIN number, VIN, vehicle identification number. So there's no way you can confuse that white Honda with the other white Honda or Toyota, whatever, because even though they look identical, they have a different VIN number. Is that new? Rachel, was that new for anybody out there? They didn't know that they had a VIN number? Sweet. Oh, anyway, automobile dealers may use specific identification because they have their own unique serial number. However, most businesses can't justify that amount of time and effort. But since the cars are manufactured with VINs, it's easy. Now, we're going to start looking specifically at these different items. First in, first out. We're going to call it FIFO, so get used to the vocabulary. The first units purchased are assumed to be sold. Did you catch that? Now, in real life, bananas are always going to be sold FIFO. That's the actual physical flow of inventory. You're not going to keep bananas for 6 months. It doesn't work that way. But you could keep the cost. The assumed flow could be not FIFO. So the first units, we're talking about this, the assumed are going to be sold first. And the ending inventory is made up with the most recent purchases. So the newest stuff. So you're going to sell the old, and anything in the inventory is assumed, even though they're identical boxes, the identical interior is, they're packaged peas, frozen peas. Well, in the beginning of this summer, peas may not be as cheap as they are in the middle, because that's when the harvest is most plentiful, right? And then towards the end, it gets more scarce. And so you would imagine that if you're a processor and you're trying to collect all the peas you can to freeze them, well, the bags of peas are identical, but the price that you paid for those peas at the beginning may be more expensive than at the middle, where, hey, you've got to sell them fast because, they're going to rot. And then at the end, the harvest season is over, so the last remaining ones might command a bigger or more money. So basically what we're seeing here is that in the preceding example, if we assume that the gross profit would be $11 and the ending inventory would be 27. So you can go up here and you can see there is first in, first out, assuming that the first one was sold first. That's what the FIFO means. Now with LIFO, it's the opposite. Under last in, first out, the last units purchased are assumed to be sold. So whenever you have a purchase, the very next sale came out of that new stuff. Assumed. You could assume that your milk is sold using LIFO, but you better make sure that gallon of milk is actually the physical flow was first in, first out. But you can assume for your costing on your balance sheet, you can assume that you're going to use last in, first out. And there's benefits and negatives to using either one of those. So basically, the last units are sold, and the inventory is made up of the earlier stuff, the old stuff. Okay, so here's the example. Then the third one is what's called the weighted average cost. So the average cost flow method, basically the cost of the units sold in the inventory is a weighted average. So what do you mean by weighted? That's what my illustration with one ice cube in a boiling pot of soup. But if you put a whole bunch of ice and a bunch of soup, it kind of averages out. You can see it's weighted because there wasn't much weight in the ice cube at first, but later on it kind of balances out a little bit, 50-50. So the purchase costs are weighted by the quantities purchased. So you buy one for $5 and 500 for $10. Oh, that $510 is much more impact on the value of the inventory than the one or two that you bought for that cheaper amount. So that's why they call it a weighted average here. So in our example up here, we knew that if we spent 9 plus 13 plus 14, that's 36 bucks. So 36 bucks, if we had 3 of them, that's an average cost of $12. So they got $12 average because it wasn't 9, it wasn't 30, it was somewhere in the middle. It's going to be about $12. And that's what they mean down here when you come down and read this. The unit cost would be $12 because the total value was 36 and we bought 3 items. And so the gross profit would be 8. Well, because we sold 1 of them at an average cost of 12 bucks. So 12 from 20 gives you $8 of gross profit. And the inventory, you have 2 items left, average cost of 12 bucks each, you got 24 bucks. So I'm going to pause right now to see if you have any questions here, because when you're done today, what you need to be aware of is that there's 3 methods, 3 cost flow assumptions: FIFO, LIFO, and average cost. And what you need to know is that the income statement and the balance sheet will have a different value, different number based on which cost flow you used. And all of them are correct. All 3 ways give you numbers that are considered accurate, even though they're not the same. Isn't that crazy? I'm going to pause right now for you to ask any questions or to give me a thumbs up and say keep going, because I've learned about 5 things already today. I'm ready for number 6 or 7 or 8. Okay, awesome. Any stop signs? All right, so what we're going to see right now, as illustrated earlier, when identical units of an item are purchased at different costs, an inventory cost flow method must be used. This is true regardless whether you use perpetual or periodic. All right, now listen carefully. Today, we're doing perpetual, FIFO, LIFO, and average cost. Next class, we're going to do periodic, FIFO, LIFO, and average cost. So 3 and 3 is 6. So there's 6 different potential answers. Good news. In this book, the FIFO are the same for periodic or for perpetual. So there's 5. So there's 5 potential answers. So let's take a trip to reality. I don't know where you live, but I live in this place called reality. And so I like to look at what General Electric is doing. General Electric has a balance sheet. There it is right there. We have all of our assets, our liabilities, and our owner's equity. On their balance sheet, they have an item called inventory, just like we're learning in our textbook right now. So in reality, this inventory, this amount of inventory could be different if they use FIFO or LIFO or average cost. So this number here is, well, what do they use? FIFO, LIFO, or average cost? Well, you'd have to go back to note 6 to figure out what they use. The interesting thing is that many years ago, when I first started teaching, right after the Earth crust hardened and the dinosaurs passed away, we had every student, every odd chapters 1, 3, 5, 7, 9, etc. They would do a current event and we would find accounting articles. And we could still do that, but we don't for a variety of reasons. So that is for the even chapters, we would have them look at a financial statement like you're looking at right now on your screen. And we say, hey, what does General Electric use for their inventory costing assumption? Do they use FIFO, LIFO, or average cost? And so the students would have to go into this statement and do Control F and look for note number 6. And they would see if they use FIFO, LIFO, or average cost. And here's the interesting thing, because I do the same thing with inventory and the same thing with depreciation. In chapter 9, we're going to see depreciation. We saw depreciation in chapter 3 and 4, but we're going to really spend some time with depreciation in chapter 9. But here's the funny thing with GE. GE uses all kinds of methods. They don't just use one, they use multiple. And so that, you know, for this area, we use FIFO, for this one, we use this, and that. But we are learning now that it's different because GE used to use LIFO a lot, and now I don't think they use it. I don't know for sure, but according to what I'm reading, is that they can't use it anymore. And I will show you in our textbook why they stopped using LIFO. A lot of people in the United States like LIFO because there's advantage, and we will see that next class. Say, well, why do they use LIFO? Because there's an advantage to LIFO. And so many companies use LIFO. So let's go back to our textbook here and go over here and say, look, so we have identical units of an item that are purchased at different costs. So it's the same, can of refried beans, the same can of tomato sauce, or the same can of, or whatever, the same banana. They're the same. But when you bought them, the price has changed. And so if you look down here in this little chart, we bought some for $20, some for $22.40, and some for $23. They're identical items, but that's going to impact our balance sheet and our income statement. So we have identical units that are purchased at different unit costs. So the inventory cost flow assumption must be used. So we're going to do this 3 times. These assumptions are facts. This is what happened. And then we're going to use the FIFO assumption to say, okay, what's the value of our inventory if we use FIFO? Then we'll do the same transactions again. Say, well, what's the value now if we have LIFO? And then we do it the 3rd time. What if it's average cost? So you're going to be able to see how that impacts your balance sheet and your financial statements and income statements at the end of this lesson. So this is true with a periodic or a perpetual. So in this section, we have FIFO, LIFO, and average cost are going to be under perpetual. Next time we do the same thing, but only we're going to use periodic. And periodic and perpetual produce different amounts, except for the FIFO one. So I need you to pay attention because we're going to see this a lot. We're going to start off with whatever inventory we had at the end of December, whatever year it was, we had 1,000 of them left. And the cost, for whatever reason, was $20 each. So last time I checked, 1,000 times 20 is 20 grand. Then we're going to sell on the 4th, we're going to sell 700 of the 1,000. Now listen carefully because we got 300 left. Because last time people, where'd you get the 300? I'm doing it in my head. I had 1,000. I made a sale of 700 of the 1,000. I got 300 left. Do I have a thumb up for at least 2 people that go, yeah, I can do that in my head. I got 300 left. So we see a couple thumbs up. Yeah, lots of thumbs up. Good, good, good. So now we've got 300 left. Well, we're going to replenish our supply of whatever these identical units are, and we're going to buy 500 more. Well, last time I checked, 500 plus 300, I got 800 to sell. And then I'm going to sell 360 of these. And this is where it gets interesting. Because if we use FIFO, first in, first out, I only have 300 left of the old stuff. And the rules of FIFO says I got to use up all 300 of those things. But I sold 360 of them. So I don't have enough. But fortunately, I purchased 500. So I'm going to take all the remaining balance, 300, bye-bye, they're gone. I sold the 700, they're gone, and the remaining 300, I have no more of that 1,000 because they're gone. Because I sold 360, I'm going to take 60 from this pile. Then that means I only have like 440 of these left because I took 60 of them. And now I'm going to sell 200 of that 440. 240 from 440. That means I got 200 left. So I have 200 left, and I'm going to buy 600 more. So here's the deal. We are always going to end up with 800 items left. Every time we do this, whether it's FIFO, LIFO, average cost, we're going to have 800 left every time. The question is, how do we know what the value is? Well, if it's FIFO, LIFO, or average cost, it's going to change. So that's what we're going to see right now. Okay. Now, when you walked in the classroom, I encourage you to make this chart. And so this chart here, we're going to use the rest of the night. So we're going to see 3 examples in the book, and we're going to walk through them slowly so you can see where they came up with those numbers. And then we're going to do 3 demo problems that mirror the book's problem. So we're going to spend a lot of time looking at this stuff. And so if you don't know where these numbers are coming from because you're not able to focus, you're going to get confused. I hate to tell you that. I don't mean to be negative, but this is accounting. This is why accountants get paid the big bucks, because it's not easy all the time for most people. So we're going to focus on first in, first out now. That means first in, we're going to assume that they had sold the old stuff first. So it's gone. What's left is the newest stuff on our balance sheet, our inventory. So when we use FIFO, the costs are included in the cost of goods sold in the order in which they were purchased. Right? So In other words, their cost of goods sold, when we sell something, the old stuff, we grab that first, and then we get all the old stuff, and then we go to the next stuff that was purchased, and we use all that up. So we go in order. That's what it says, the order in which they was purchased. That's how we get the cost involved. So the old stuff is first captured. This is the same as the physical flow. And I spent 10 minutes talking about, hey, it doesn't matter what you do with bananas, you better sell the old bananas first because they're going to turn black and nobody wants them. They're all slimy. So the FIFO method often provides results that are about the same as they would have been by using the specific identification. So the first one is the first one you're going to sell. So again, when we talk about grocery stores with perishable items, they're always going to rotate the stock and put the old stuff out front. So when people come run into the grocery store and they grab a loaf of bread or they grab a jug of milk or orange juice or butter or whatever, they're cold cuts, whatever they're buying, the new stuff is buried in the back. They want to get rid of and sell the old stuff. It's still good, but they don't need to sell the brand new stuff when you have old stuff that could expire within a week or so. So get them off the shelf. So here's the illustration now. I'm going to show you this little yellow thing. Now, this yellow thing on the right-hand side is identical to what we were showing you here. That's what, so if you haven't made it, now you can make it here. This is the same thing. So you're going to need 3 of these. One for FIFO, one for LIFO, one for average cost. You could have a very long 8.5 by 11 and have the first 6 or 8 lines and then draw a line, and that's for FIFO. And then the next section would be for LIFO, and the next section would be for average cost. Either one works fine, but here's the scary part. This on the left-hand side is what we did in chapter 5. So if you didn't understand chapter 5, you have another chance to understand it now. Or if you understood it last time, good news, it's a review. So this is what I call a 4-liner, because over here, we purchased, right, a bunch of stuff in the olden days, whatever it was, when we had a remaining inventory of 1,000 units that cost us 20 bucks each. And then we're going to make a sale. And so when we make that sale, I need you to get a calculator out if you have trust issues, because I'm going to have you multiply 30 times 700. Now I can multiply 3 times 7 in my head. It's 21. So this value of the sale, we're going to have to capture how much money the customers gave us. Well, they didn't give us money. We bought it on account. It's going to be 21 grand, $21,000. Because 700 times 20 is going to be, I said the wrong number, 700 times 30 is our revenue. The 20 that I accidentally mentioned 2 seconds ago is going to be the cost of the goods sold, because 20 times 700 is 14,000. So you're going to see 21,000 because 30 times 7 is 21,000. And then you're going to see 14,000 because 20 times 7. That's the cost of the good that we sold. So we turn the page, and sure enough, look right here. The first revenue was $21,000 because we sold 700 items at 30 bucks each. And so we capture how they paid us. They didn't give us money. They said it's on account. So we got an asset, but it's called an accounts receivable for 21 grand. And our revenue went up. We also captured, because we're on perpetual, the cost of goods sold and the inventory that went down. So the cost of goods sold of the 700 items that we sold times the $20 is 14,000. So I'm going to pause right now. Do I have at least 5 thumbs up that understand? I don't understand where you got the 21,000 here and this 14,000 there. Is this from the other page right now? So if you can't put your thumb up, this is your moment to ask the question. Because when we come over the chart here, the very first line is our beginning inventory. We had 1,000 units at $20. So when we come back to here, you're going to see 1,000 units of inventory that cost 20 grand is now $20,000. Any stop signs on that? The next line, we're going to capture the sale. And apparently we sold 700 items. That came from the previous page. I've showed you 3 times. It cost us $20 because that's all the inventory value that we had, $20 each. We got $14,000. Now, according to my finger math, if we sell 700 of my 1,000, I got 300 left. Does everyone see where I got the 300 here? I started with 1,000. I sold 700. What is this left? 300. So the value of my inventory that's on the shelves right now, after I sold 700, this is the cost of goods that were sold. So the cost of the inventory that's left is 6,000, because 6 plus 14 is 20. We have 300 items at $20 each is $6 grand. So again, I'm going to pause right now. We've got 2 lines here. Any questions about where they come up with these numbers? This chart is nothing but a chart. This author has come up with this chart. I think it's wonderful. I like it a lot. I've used probably a dozen textbooks in my career teaching accounting. And many times, especially in the olden days, we used this a piece of scratch paper. And I just write this on a piece of scratch paper. But as a teacher, I appreciate his Excel spreadsheet or this table that would be on Word, where you can see where the numbers are coming. So you kind of have a visual impact of what's happening here. We started with this much, we sold this much, and now we have this much left. Any stop signs? Because now the fun starts. Because the very next thing is that we are going to sell a bunch of stuff here. All right. So we're going to come back to the first page. We started with beginning inventory. We sold a bunch of stuff. That's our $700. Now comes the fun. We're going to buy more stuff. Could somebody please take 500 times $22.40? Do it right now because it will help you understand. So if you just take 500 times $22.40, that's going to help you. If you can type it in or shout it out, either one works. Or I'm not sure I can read sign language, but that would makes you happy. Maybe somebody can translate. 11,200.
11,200.
Yep. Okay. We got 2 independent confirmation. So I'm going to turn the page. Remember 11,200. It's in the chat right now. 11,200. See 11,200 here? Because our inventory went up because we purchased more inventory. 500 items at $22.40. Do I have at least 5 thumbs up? Yeah, I see where they got the 11,200. Because here's my 500 items at $22.40 for the cost of the merchandise that we purchased was $11,200. That's where these 3 numbers came from. We saw it in the first page. So I'm going to pause right now because I can't teach you the right side of it until you understand the left side. Are we all good with these numbers that are on the left-hand side? Because since we have 300 left from the earlier transaction, we're going to buy 500 more, but they're different value. They're identical units. So you can see right now, I had this 320 and then 6,000. I'm going to bring those 3 numbers down because I still have them. But I'm going to add to it the 500 new items that cost $22.40 for a total of $11,200. So if you were to say, hey, what's the value of my inventory right now? I would add up 6,000 plus 11,000. I had 17,200. That's all we're saying right now. So I'm going to pause right now. We've got 3 lines here. The first 3 lines, first, fourth, and 10th. Are we 3 for 3 with Mr. G? Give me a thumbs up if you're happy and you know it. You understand what's going on, where the numbers came from, and you totally feel comfortable. Or you can tell me, hey, I got a question, or you can ask a question right now, or you can say, wait a minute, I'm just still writing. We're not writing anything, we're just looking at it. All right, you ready for the next line then? Any stop signs? The next line down here is that we're going to, again, back to here, after we purchase 500, we're going to sell 360. But remember, we have 2 piles of inventory left. One pile was a $20 pile, and we only have 300 left. But we have another pile of 500. So we've got plenty to sell. The question is, do we have enough to sell all 360 from the beginning inventory? No, we only have 300 left. So we are going to have to take every one of these 300s that we sell here, every one of them is going to be gone. The cost of the goods sold. So this 300 is going to be used up. But I need 60 more because the customer wanted 360, but I still have 500 of the new batch. So I'm going to take 60 out of the 500. That says I have 440 left over. See the 440 here? Because I sold all the oldest inventory and a few of the 500, 60 of them. So there's 440 left. So again, if you have trust issues, take a calculator, take 300 times 20, that's 6,000, or 60 times $22.40, you get 1,344 pennies, $44. And then what's left over? Well, what we have here is the 440 times 22, we have $9,856. So I'm going to pause right now because we're halfway through this chart, and this is the time for you to ask questions or to tell me to slow down, or to give me a thumbs up and say, keep going, and we'll get out of here before midnight. Any thumbs up that say, let's keep going? Yep, I see a lot of thumbs up. Okay, some stop signs at all? This is the time to ask.
I have a question.
Yep.
So on the 360, the total of the sales per unit, the 22 sales of $30 per unit, we just pretty much did the whole 300 as a whole, and then we did the 60 separately.
Okay,
I'm a bit confused on the 300 and then the 60.
Yeah, this is the $30. This is what you'll notice, that every time we make a sale, the sale, $30, sale, 30 bucks, sale, 30 bucks. We kept the same sales price. What's changing is the cost of the goods that were sold.
Yes.
When we're not really doing the revenue at this point, but when we were taking the 360, we only had 300 left here, right? We started with 1,000 and then we sold 7 of the 1,000. That's
Okay,
300.
that makes sense. Okay.
So we got to sell 360, but thank goodness we bought 500 more, right? So when we come over here, you can see that all right here of the 300 that was left is wiped out now because we sold that. That's gone. So there's the 300. All that 300 is gone. Here's my other 60 in order to get to the 360 that the customer wanted. That's totally cool because I still got 440 left. That's the 440 of the $22.40 version. The $20 stuff has all been sold. Are we good with that? Excellent. Now over here, our new customer shows up and says, hey, I want 240. You got 240? And we look over here and say, yeah, we got 440. We can sell you all. We got plenty to give you. And so we're going to sell all of it. What's left over is 200. See the 200 down here? Because we sold 240 of the 440. That means the remainder of 200 of the $22.40 one. So here, all of this is sold at $22.40. That's the 5,300. That's the cost of the goods that were sold because we had to pay $22 from that. We charged them 30 bucks, right? We made a profit, but it cost us a little bit more than it did up here. We have a little bit higher cost. So what we have left over is the $4,480 of inventory left over because we only have 200. But the very, very, very last transaction is that we are going to, timed out of me again. This is exactly the same time. It was 10 or 12 after, before. Silly old thing. I don't think he's going to be happy here. No, I got to start all over. How cool is that? Isn't this wonderful? You get a little 2-second break here for you to do some easy stretching, kind of work on your smile and a good attitude. And so maybe take a drink of water or do some push-ups to kind of wake up a little bit. Yeah, another sign. No, I heard you and I are on the same page, brother. I like that. All right, so I just refreshed it. Let's go back over here to modules. And let's see if we can find my ebook. So chapter 6, inventory. Let's see if it remembers where I left off. I think I was trying to go, it was the same thing. I was trying to go back to the first page and it says, you're done. It's Thursday. You've been working hard. Now we're just getting warmed up. We still have a lot of fun to happen. We've got another hour. What I was trying to show you here is that we have the last transaction. We're going to buy 600 more items. And as I said before, we know that there's going to be 800 items left over because we had 200 left over that we saw before, plus we just bought another 600. Here's the 600. So we're always going to have a leftover amount no matter what. For FIFO, LIFO, average cost, there's a fact that we're going to have 800 left over. How do I know what's 800? Well, each time we sell something, there's only here 200 plus the 600. It's always going to be 200 and 600 in this example because there's 800 left. Right, so that's what we have. Somehow it's going to be a mixture. It's not all. If FIFO is going to be 200 and 600, but LIFO might be different because it's going to come out of different piles. But either way, we still have 800 items of inventory. The composition is 200 of this medium old stuff and then 600 of the newest stuff. So what I was trying to show you, and I wanted to show you this, we talked about last time that we had accounts receivable / guest products. Remember that discussion? And every time we had accounts payable / and then the name of the company that was our vendor. And I was explaining that the high school book does a little bit better job showing it. And so what I did today is really interesting because high school and a college accounting are identical. We use the same product, Cengage. It's the same material. The difference is high school goes super slow. So here we are after 8 months of school. I guess it's only been 6 or 7 months. We are in the same place as you guys after 4 weeks of school. All right, so 4 weeks and 8 months. Okay, we're going really fast in college. But I wanted to show you what those subsidiary ledgers look like. If I can get this right here. Here it is. So here's the journal that we're showing. I'm just showing the same thing. This is the controlling account, and here's the accounts payable / in the name of the company. You'll notice that they divided that in two because the post reference, the account number for accounts payable goes on the top, and on the bottom, that's for the vendor. So if you come over to here, this is the general ledger here. This is our supply store. So that number here is account number. You really can't really move this over just a smidge. There's 1550. That's the post reference, just like we did in college. It's the same exact stuff. But when it comes time to post this, we'll do the accounts payable. There's the accounts payable. We write the date, write the page number, write the amount, 2 credits added up, get the new balance, go back and put account number 2110 in the itty bitty box. Well, the itty bitty box got smaller because we divided it into 2. And then the bottom portion is for the vendor here. This is the Estes supply. They're both going to be, credits, but one is the customer or the vendor's ledger that we keep track so we know exactly how much we owe them. And then this is the general ledger that's for all customers. And so when we look down here, hey, we got to pay 13 grand to our customers. Oh yeah, how much to each person? I don't know, but we do know because we kept it separate up here. We have a subsidiary ledgers. I'm not sure that helps anybody, but I just wanted to show you that I'm not just making this up. This is how it is in real life. And again, I recommend spending some time in reality. It's a good place to stand around. So if we look over here now, we are done. So we have 200 of the older, not the oldest, but the older stuff, and 600 of the brand new stuff. So this 3 lines here is the same as these 3 lines. So we have to, in this case with FIFO and LIFO, we have to add up these 2 blue numbers because 4,000 plus 13 and change gives us 18,000. So the value of my balance sheet inventory has to be 18 grand. Whereas over here, we have 26,720 because we added these 4 numbers up. The cost of the goods, we just add up this column. We didn't add up all this column because that's not running balance. This is what the last 2 items that we have left. We only have these 2 items. But here, these are all of our costs of the goods that we sold. So we get 26,000. Okay, we're going to keep going because we're kind of running out of time. So you want to be familiar because you're going to see that the next time we do LIFO, it's going to be different numbers here. Our balance sheet is going to be different. So when we do our real, it takes us about 45 minutes to do the real demo problems. And so we haven't started that yet. So you can see right now, it's got to keep moving. You will notice that behind this, below this yellowish graphic, is a bunch of words that I haven't even highlighted. The reason is that these words are what I just spoke to you. I encourage you to go back this weekend. There's nothing on TV that is important. You can go back and you can reread this section and refresh your memory where all these numbers come from, because that's what these words tell you. The very next section is LIFO. We're going to go a little faster because at first there's no change of scenario. For instance, down here it says LIFO method is used. The cost of the unit sold is the cost of the most recent purchase, because last in is first out. So if you made a purchase, the most recent purchase, that's the stuff that you sell first. You make another purchase, you ignore the stuff that has already been purchased and you deal with the most recent purchase. You sell that pile first. You don't sell it all, you got two piles of remainder. So the LIFO method was originally used in those rare cases where the units sold were taken from the most recently purchased unit. That's my cone. The rare cases where you take your front loader and scoop out the outer layer of the gravel, because that's the last in, is the first out. But there's other advantages. We'll see that next time. However, for tax purposes, that's the reason, LIFO is now widely used even when it does not represent the physical flow. This is the problem because of IFRS, the International Financial Reporting Standards. Those rules don't allow LIFO anymore. So we'll see that. There's a section down below that the book will actually introduce that topic. So the impact of LIFO is discussed later in the chapter. So here we go. The first two lines are identical. Why? Because we started with a beginning inventory and we made a sale. What is different here is that it's still $700 and it's still $20 because we hadn't had a new purchase yet. Had we made it a purchase, we'd have to come out of that pile. But we had 1,000, so this is identical in here. And we still have this much left over after we make this, the next line here, and we made that sale of 700. We still have 300 left over. But over here, we're going to make a new purchase. And this is where it gets fun, because now this new purchase costs us $22.40. And we did this math earlier. This does not change, because that's a fact. We bought 500 at $22.40, so that cost of our purchase, our inventory went up by that much money. And so you can see that money down here. There's 11,200, it's the same. And this is what's left over. We had 300 of the oldest stuff, and now we have 500 for a total of 8. So these three transactions don't change because the scenario was that we haven't had a sale yet after the first purchase. But now we are going to have two sales, right? Now, this is, we just bought 500, and now we're going to sell 360. Do we have enough to come out of the 500? Yeah, we do. We have plenty. We can take all 360 out of the 500. And if you can do that in your head, 500 minus 360 is 140. Look down here. See the 140? That 140 came because you started with 500 and you sold 360 from the last in is the first stuff that's going out. So you got 360 of this is gone for 140, but you still have all the oldest stuff still. So there again, 360 times that, we have a different cost of goods sold number now, because we are using the most recent purchase with LIFO is gone. Had it been the customer wanted, 560, we would have depleted this 500 totally, and we would have had to gone into this 300 to take more out of that pile, but we didn't. The customer only needed 360. We had plenty out of the most recent purchase. Doesn't matter. We have 800 total, so we could have sold everything. Doesn't matter what. So down here, we have another situation where they want to buy 240. Right. The second one, if you don't remember, I'll go back a page or two. We've got to go back 2 pages now. So we sold the first time 700, and then we bought 500 more. Now we sold 360 out of that 500, so we had 140 left. The next sale, the third sale, we're going to sell 240. Well, I only have 140 of the most recent stuff left, so I have to dip into my remaining 300 for the extra 100, right? Because I want to sell 240. I only got 140 left because I took 360 away from 500. So maybe it'll be easier for you to see in the graphic over here. So we'll click a couple times. Here we go. There is the 140 because the customer wanted a total of 240. So this entire line has been sold. It's gone. You can see that right here, that number there and those three numbers there, gone. But we needed 100 more, and that 100 is going to come out of the 300 pile. So that means there's only 200 left, right? 300 minus 100, I got 200 left. I need 240, so that means all of these and 100 of these. So there's my 200 left. So I'm going to pause right now. That's kind of a crazy one on the 28th. I'm going to pause right now. I'm either going to have 5 thumbs up going, I get it, keep going, we'll get out of here before 10 o'clock, or you give me a stop sign or you unmute yourself and ask a question. Because I'm happy to help. This is what I live for. I don't stay up late just because I have nothing better to do. I mean, I love this stuff. Okay, so the very next item, we only have 200 left. You can see there's 200 left. That line down here, that's a remaining balance of the older stuff that we have, this old stuff up here. So we're gonna buy 600 more. So we still have 800, but look at the composition. We have on our books, the very newest stuff on the books and 200 of the oldest stuff. Where if you went back a page, it's a different composition. We still have 800 items, but they don't have the same value. So this is $17,980, and the cost of goods sold is 27. So let's go compare and contrast. This was 27 on the LIFO, and this is 26. That's a different number. This is 18,000, and this over here is 19 or 17,000. Very different numbers. So I'm going to pause right now to see if you have any questions on the FIFO and the LIFO. Because now we're going to do average cost. And the average cost is a weighted average cost. So we have to calculate a new average cost every time you make a new purchase. All right. So here, our first purchase is way down here. So we got the first 3 lines here that aren't going to change because nothing's changed because we don't have a new purchase. But after the purchase, we're going to have some fun. All right, so here we go. Notice that I did not highlight any of these words underneath the LIFO because it's the same strategy. I talked about it. You go back and read it yourself and refresh your memory. That will help prepare you because the test is going to have the same kind of a problem. Okay, here's my weighted average cost. And so the weighted average cost is used, for each item. For each item, we're going to calculate a new average cost each time you make a new purchase. And so you'll notice something weird down here. I've actually highlighted these words because we're going to talk about these words first. So the first 3 lines don't change up here. Look, we start with 1,000, 20 bucks each, 20 grand, same. Then we make the sale of 700. That's the same. Nothing's changed because that's all we have. We only have the $20 flavor left, and so that's what we have. And so we have 300 left. So the first 2 lines are identical. Then we make a purchase. These 3 numbers did not change. Very good, so far so good. But this is where it gets crazy. Does anybody have the skill to add 6,000, the old balance that was left, plus our 11,200? Can you add 11,200 plus 6,000? Get a calculator if you need to. But it's 17,200. Does everyone see where this 17,200 came from? I'm going to pause right now because this 17,200 came from 6,000 plus the new purchase. So what is the value of my inventory that's left? Well, whatever I had from the old stuff, 6 grand, and what I just bought, 11,000. Do I have 5 thumbs up? People understand? Or is there any stop sign? 1 stop sign, I stop. 1 thumb up, 2 thumbs up, 3 thumbs up, 4, 5, let me turn the page. 6, 7, 8. Okay, so we've got a lot of thumbs up. Are there any stop signs? Get a calculator out right now. If you don't have a calculator, get your cell phone. If you don't have a cell phone or a calculator, use your Excel spreadsheet. Everyone's got a browser. If you're using Chrome, it is a free Google Sheets. You can do it on an Excel spreadsheet or Google Sheets. Would you please take 17,200 and divide it by 800? 800 is how many items you have left. You have 300 plus 500. So what is 17,002 divided by 800? What is your answer on your calculator? This is how it's called kinesthetic learning. You will learn how to get the answer. We got 22.5. I said the wrong number. 21.
2150.
Yeah, 21.5 is $21.50. Raise your thumb if you see in the chat that Casey put down $21.50. And we also calculated by this number, so it's $21.50. That is the amount, that's the new average cost. So now when we sell 360 of them, that's the next item. All of them are going to be sold out of the 800. That means I have 440 left. You see how we're doing this? 440 times 2150 gives me 9,660. I'm sorry, 9,460. And over here, this sale, all 360, the average cost was 2150, and so it came to 7740. So I'm going to pause. This is on the 22nd. Does everyone see where we got every stinking number? 360, 2150, 7740, 440, 2150. These are not mystery numbers. They all came from somewhere. So I'm happy to say, where'd you get that number? I'll tell you. You won't lose any sleep. That's my goal, to have you sleep restfully, not wondering, where did you come up with that $21.50? Any stop signs? Because the next one we're going to sell 240. We still have plenty, right? We had 440, so we're going to sell 200 out of the 440, 240 out of the 40. We have 200 left. So again, we can do the math here. 240 at $21.50, 51.60. We have 200 left, and the average cost is $4,300. But now we're going to have one more purchase. This is where we get to calculate a new average cost. When you have 200 left and you buy 600 more, do you agree that we have 800? We've seen 800 for the third time now. There's always 800 left. But now I need you to get a calculator. Can you please add 4,300, the old ending a total cost of the inventory? You need to add it with the stuff that you just bought. So can you add 43 to 13,900? What does your calculator say? When you take 4,300 plus 13,980. I got, somebody says 18,280. Do I have an independent confirmation? Anna's looking pretty comfortable. Casey's giving a thumbs up, and she agrees with that, and you're right. So would you please take 800 and divide it into 18,000? So okay, 18,280 divided by 800. That gives us an average cost. Write this down so you can remember how to do it. Does everyone see where we got 2285? Anna's got 2285. Give yourself a pat on the back. Does anybody agree with Anna and the book? Who's going to be my tiebreaker? Anybody go, yep, I'm seeing it. See some head nods? Excellent job. Now I'm going to pause because notice that we did not add on the average cost, right? We just did the multiplication here. That's how we came up with these numbers. Before we had two piles left, we had to add them together. We don't have to add because there's only one pile here, the average cost of 2285. And over here, we have to add this column up to get 26. Now notice that 26,900 is not the same as this one over here, which is 27, and this one here, which is 26. So 26 and 27, do you see how it's in the middle? We're going to see this as we do when we do our other one, our demo problems. It's in the middle. So our weighted average cost, the cost of goods sold, will be in the middle, typically. That's what you would expect. That's what you will see. So I'm going to pause right now. Does everyone see where I got those numbers? Because if not, we're going to answer the questions right now. But if you understand, I will now take you to the demo problems. So when we do the demo problems, you're going to be able to practice and see if you can do it. Okay. All right. Any questions? Because here we go. We are going to now dive into a demo problem. So I'm going to duplicate this tab because we might need this for reference. And I'm going to open up an exercise. And the exercise is kind of interesting because we're going to do 3 demos right now. It's going to take us about 45 minutes, 45 minutes to get done with this. So I'm going to go into my table of contents and I'm going to scroll to the bottom. And these are exercises, which means that they're not as tricky as the problems and not as easiest than the basic exercise. So open up the exercises and scroll down. Now we're going to do LIFO, FIFO, average cost. The problem is the first thing that we're doing is down here, we're going to do FIFO first. It says perpetual inventory using FIFO. So it's exercise 6-10. And this is where it gets a little bit tricky because it says this company, I don't see any numbers. You know, it says no, well, wait, if you read carefully, it says use exercise 6-9 for the numbers. So scroll up and there it is. We have inventory and sales and a purchase, another sale and another purchase. So what we're going to do, we are going to do FIFO, LIFO, average cost. So the last one will be 6-9 that we do, the third problem, which is the top of the pile here. The first one that we do is FIFO, that's in the middle of the pile. And the second one that we'll do is at the bottom of the pile. All of them use the exact same numbers in 6-9. Do we have understanding of what we're doing here? So I'm going to go into my Word document here. Open up that. And open up this right here. So here we go. There it is. 6-10 is our first one. So you'll notice that on my 6-10, I'm using the numbers from 6-9. And you can look over here. Inventory, sale, purchase, sale, purchase. This is the same as this information here. So you can scroll down and I'm going to keep it on 6-9, but I'll scroll down here. And so we're going to use FIFO. So what does this mean? Well, we start off with 4,000 times $40 each. Well, 4 times 4 is 16. There's a bunch of zeros, so it's 160 grand of inventory that we have on our books. So at the end of the fiscal period on December 31, we had inventory left over totaling 160,000. So you'll notice that I have now this chart. So let me just move this over a little bit so you can see. And there's my 9 columns that we were talking about before. And so since we're going to start with the first transaction here on January 1, what do we have? So our inventory, the quantity is 4,000 units. The unit cost is 40, and the total cost, we do the math. We multiply them out. And so now we have 4,000 times 40 is 160 grand. I see a lot of head nods with thumbs up in the background. That is an indication for me that you're participating, number one. But number two, you are also ready to move on. Because if there's a stop sign, we stop. The second thing is we're going to have a sale. The question is, I've got 4,000 units. Can I sell 2,500? Yeah, I can sell. I have plenty. I got 4,000. So can I sell 2,500? I sure can. That gives me 1,500 left. Do I have any questions about where I'm getting these magic numbers? So when I make a sale, the cost of goods sold, I'm going to sell 25 of these $40 volumes. So over here, the quantity that I'm going to sell is 2,500, and the unit cost is 20. So if I do the math, I'm going to get 100 grand here. Because 25 times 4 is 100. So we got to add the zeros there, so it's 100 grand. Well, logically, if I started with 160 and I sold 100, I got 60 left, right? Or you do the math, 15 times 4 is 60. So I'm going to pause right now. You guys fill that out, but what's more important, you have to assess whether or not you are comfortable and understand it. If so, you give me a thumbs up. If you are wondering what's going on, you're going to have to ask questions. Okay, a lot of thumbs up. So I'm going to specifically ask, are there stop signs? You folks that are watching the video, you're going to have to ask questions later on if you can't figure it out. Or ask somebody in your group. Because there's always a few do-gooders somewhere that go, oh, this is the easiest thing ever. I like this stuff. And there's always a whole bunch of us normal folks that go, what's he talking about? I mean, you have to have somebody kind of walk it through you. Hopefully we'll figure it out. Okay, so the next thing that we're going to do is that we've sold, and would you agree we have 1,500 left? We started with 4,000, we just sold 25. So it's 1,500 left. Well, I'm going to buy 4,500 more. So you're going to purchase. So I'm going to have 6,000 total available to sell. So I'm going to buy that right now. So our over here, the purchase is going to be 45 times 44. So if you get a calculator out and take 4,500 times $44. That includes our purchases. So over here, you can see that I had 4,500 quantity times the unit cost is $98,000. Let me try that again. $198,000. Sorry about that. And so over here on the right side, you can see that I just brought down my existing balance of the old stuff. I only had 1,500 left. But I'm going to add to that 4,500 of the $44 type. So I'm going to have 198. So if I would add these two numbers up, that's the value right now of my inventory, according to my balance sheet. Any questions? Because I'm going to sell 5,000. And because I'm doing FIFO, I don't have 5,000 of one type. I've got 1,500 and I got 4,500. So I've got plenty total. I've got 6,000. I can sell 5 of the 6 and still have 1,000 left over. The question is, what happened to my inventory? Well, because we are on first in, first out, the assumption is every one of these older versions gone, bye-bye. So that means I need another 35 out of this 45 to complete my sale. The customer wants 5,000. So I'm going to give them all of these plus 35 of these. That means I have 1,000 left over. So when we come over to here, the cost of goods sold, we have every one of these old ones are gone. Every one. But we need to dip into the newer batch, and that's where we get the 3,500 here, because I want to give them 5,000. But the newer batch cost me more money, $44. So multiply 3,500 times 44, you get 154. And what's left? Well, I had 6,000. I gave them 5. I have 1,000 left over. Of what kind? The more expensive ones, the newer ones, and that's $4,400. 44,000, excuse me. Now, I'm going to give you time to write, but also time to process. And when you're done writing and done thinking about it, you have a chance to participate. Tell me with words, with chats, or with things, say, I get it, give me some feedback, or give me a stop sign. Say, wait a minute, I don't understand this, or give me a few seconds. I got a couple thumbs up. I got a few more thumbs up all of a sudden. So lots of thumbs up. Now the time to ask specifically, do you have a question? Like, where'd you get 1,000? Or whatever number. If you don't know where it came from, I'm happy to tell you. Okay, so we just made the sale of 5,000. You can barely see it up here on the top. So now we're going to buy another 2,000. Now, according to my finger math, if I had 1,000 left over from the earlier transactions and I buy 2,000 more, I think I got 3,000 total left of inventory. That's every time, whether you're FIFO, LIFO, or average cost, we are each time are going to have 3,000 items left over. The question is, which pile are they coming from? The $40 pile, the $44 pile, or the $46 pile? And so the question is answered, well, it depends if you're using FIFO or LIFO or average cost. All right, ready for some fun? So we're going to buy 2,000 units. So over here, there's my 2,000 units right there. And so you can see that the 2,000 times 46, 46 and 46 is 92. That 92,000. So there's my 1,000 that was left over from the earlier balances. I'm going to combine it with my 2,000 I just bought. So these three numbers are the same as these three numbers. And then that tells me how many items I have left. I've got 3,000, and the value, I just add these two numbers up. So I'm going to pause. Does anybody any stop signs or questions about where are these numbers coming from? Because now we have to add them up. We have to get balances. So, well, what is our total cost of goods sold? What is our total balance of the inventory? How many items are left over of these identical units at varying cost? And the answer is, I've got 3,000 items here. But if you take these two numbers and add it together, that's 214,000. But then you got to add the 100,000 up here. So 214 plus 100 is 314. So there's your 314,000. You had to add these up. And over here, we don't add up all these numbers. It's only the last two numbers. We only have two piles left over, right? We've got the 44 pile, $44 one, or the $46 one. The $40 ones are gone because it's FIFO. We sold enough. I mean, you can see how many times, well, how many things we sold. We only started with 4,000. And so we sold 25. There's 4,000 right there. They're gone, right? And then we went a little bit more. So obviously the old stuff is completely gone. So what does this mean in English? I want to show you a little graphic that might be helpful for you to kind of see. We started with this at the very first and said, that's what we just filled out. So I'm going to come over to here. I'm going to come down to here and say, all right, so what we have, believe it or not, over here is that our normal balance for our cost of goods sold is a debit of 314,000. See the 314 here? That's this number here. And what is the balance of my inventory, my asset? 136. There's my 136 right there. So I'm going to pause right now. So what we're going to see is that the FIFO has a different number than the LIFO. So all these things are all part of our exercise. This is 610, then we'll do 611, then we do 69. Those three items, we're going to have different ending balances for your balance sheet, your inventory, and on your income statement, which is your cost of goods sold. That implies that we're going to have a different net income, a different gross profit, and a different balance sheet number. And they're all correct. So I'm going to pause right now until I have at least 5 thumbs up with no stop signs. We're ready to move on. 1, 2, a lot of thumbs all of a sudden. That's really good. Good job. Good participation. So I need to find out if there's any stop signs. Otherwise, we're going to keep going because we can feel the excitement and the tension build into the air because we've done FIFO. We can't wait to get to LIFO. It's like open up birthday presents or Christmas packages. You want to get to the next one because that was really good, but the next one's going to even be better. I just like bigger. All right, so here we go. We're going to go down to the next problem. The next problem is 6-11, and it's, believe it or not, it's the exact same scenario. It's still the inventory, the sale, the purchase, and the sale and the purchase. It's going to be identical. You can see right now, there it is. I just copy and pasted. We're using LIFO now, but it's the same scenario, same dates, everything's the same. But watch how the balances change. Our balance sheet's going to be different, and our income statement is going to be different based on the fact that we're doing last in, first out inventory assumptions. So here we go. You will notice that the very first line is identical because that's a fact. It didn't change. Now, what I mean by that, we had 4,000 items at $40 each. Our total cost is unchanged. I mean, it's the same no matter what. That's what we started with. That's a fact. And again, these authors have come up with this grid that's useful for education. I personally like it. I think it's a very good way of showing this. When I was a student in the earlier years, we used to do it on scratch paper. And we just kind of keep, ahead, we have a pile of this and a pile of that. But I like how this spreadsheet thing, maybe an Excel table or a Word table, I'm not sure what it is, but it still identifies what is going on. So the very next transaction here is that we're going to have a sale of 2,500. So the question is, do we have enough to sell? Yeah, we do. We've got 4,000. So we take 25 from 4,000 and all of a sudden we've got 15 left over. So the cost of the quantity, we're going to sell all the amount here, all 2,500 units that cost $40 each. That's $100,000. And what's left over? 15,000. 15 plus 25 here gives us 4,000. The cost was $40 because we have 60 left over, 60 grand. Now you will be right if you say, wait, that's the exact same thing as FIFO. How come? Well, because we haven't had a new purchase yet. We've had a sale, but when we have a new purchase, then the very next sale will come out of the newest purchase. Whereas FIFO kept pulling from the oldest stuff until it was empty. Now with this one, we're going to have a purchase. You can see barely up here in the top, we're going to purchase some stuff, right? We're going to buy 4,500. Same scenario. We're still going to have 6,000 total to sell for the next sale when we have our 5,000 sale. But this is going to change because now, once we have this new pile of stuff, the very next sale is going to come out of this first, right? The last in is the first out. So the last stuff in is on June 30th, and that's going to come out momentarily. So what we're going to see right now, we're going to purchase that on the left-hand side. We bought 4,500 items at $44 each for $198,000. If you don't believe me, take 4,500 times $44, get 198 grand. And so our inventory is comprised of two piles. We have the beginning inventory, the remaining of 1,500. So these numbers that were here in the middle are carried down because we still have all 1,500 of them because we just purchased more. So we have this remaining from the initial inventory. And then we're going to combine that with my 4,500. And you will see that I now have 6,000 items to sell. But what we have is 1,500 of the oldest stuff and 45 of the new stuff. We do the math here. So our total inventory would be, if we want to know right now what our inventory balance or balance of our inventory, we just add up these two numbers. So 258 grand. Because here comes the fun part. The very next transaction, you can see down here, it's right. We just made this purchase. That's that purchase right here. We're going to make a sale. And the question is, well, how much are we selling? Are we going to make a sale? How many items are we selling? Well, we're going to sell 5 of the 6,000. So here's my 6,000. I'm going to sell 5. Wait a minute. I only have 45 in this pile. That means I'm going to sell with last in, first out. Every one of these are going to be gone. But I got to dip into this and take 500. Right? If I'm going to sell 5,000, I got 45. That's all gone. I need another 500 from here to get my 5 grand. So the customer doesn't know what pile it came from. They're identical. They're happy. And so when we sell the cost of goods sold, every one of these things are gone. Right here, the 4,500 are gone. So we come over to here. There it is. Last in, first out, that's all gone. So I just take these 3 numbers, put it over here because every one of them is gone. But I still need 500 more to get to the goal of 5 grand. So I have to dip into this 1,500 pile, still have 1,000 left. There's my 1,000. And so if you look over here in the middle, you can see that the additional 500 items were taken from the beginning inventory amounts. And that's why there's 1,000 left. Because I had 15, I had to give up 500 more to make this into 5 grand. So I'm going to let you copy that down, and you can either ask me questions now, or you can tell me to stop, slow down, or tell me to keep going. So I will know when you're ready to keep going because you'll put your thumb up. I see 1 thumb up, 2 thumbs up, 3 thumbs up, 4 thumbs up, 5, 6, 7, 8. Ooh, we got a lot of thumbs. 9, 10, lots of them. So let's go to that video. Who's got, is there a stop sign? Is there, wait, I'm not done yet. That can happen. That's allowed. All right, the very next thing here is that we're going to purchase more, right? So in this case, we're going to purchase 2,000. As I said before, we're gonna have 3,000 left over. We got 1,000 of this old stuff plus the 2,000 of the brand new stuff. So if you look on the left-hand side here, I'm gonna buy 2,000 items that cost me $46 each. Now the price has gone up. So 46 times 2 is 92. You can follow along in your head. And so what we've done now is we've brought these three numbers down because that's our ending balances from the previous transactions, right? That's how much is left in this case, in this LIFO, of the beginning inventory. We're going to combine it with the 2,000 that we just purchased. That's a total of 3,000 that we have on our shelf. But the value of that is $46. You can see we just copy these three numbers over here on the right side. So when you combine these numbers, again, the bottom line, I still have 3,000 items, but you have to add up these two numbers. So this is 218 right here, plus 100 is 318. It's the cost of goods sold of 318. And over here, the inventory value is 132 because we had 40 and 92. We had 40 of the old stuff and 92 of the newest stuff. And so the value of my inventory is 132. So if I were to come over to here to my trusty Excel spreadsheet, and I would say right now, for my inventory with LIFO, it's going to be 132. And with LIFO, for my cost of goods sold, it's 318. So what you are seeing here is that I've got totally different numbers based on the same assumptions, right? The same sale, the same purchases, everything's the same except when do I count the inventory? Is it first in, first out, or last in, first out? And you can imagine if your cost of goods sold is an expense, that number is going to make your gross profit different. It won't be the same. And your balance sheet will have a different total assets because this is not the same as this. Now I am ready to do the average cost. Average cost is fun. It's going to take a few minutes, but it's not that long. But I'm going to wait to see if there's any questions. I will know when you're ready. I see some thumbs up. Some people that are chomping at the bit and say, let's go. I'm ready. I got one thumb up on one page. I still not have a lot of others, 2 and 3 on the other page, 4 on this page, a couple live thumbs up. It's kind of fun to see a real thumb instead of a animated thumb or illustrated thumb. Okay, so what we're going to see here is that the very first couple of transactions don't change, right? For FIFO and LIFO, the top line, the second line didn't change much, but it was after we had a purchase that things got different because then we had different piles to pull from. Well, with average cost, it's the same kind of a item that changes how we calculate things. In other words, after purchase, we have to calculate a new average cost. Whereas here, after purchase, we have to figure out, okay, what happened to my inventory? Which pile is it coming out of? FIFO, LIFO, what happened? So the month doesn't matter is the question I have right now, the month. And that is true. Over here, if you're looking at this, I think, Jacob, I could be wrong, but help me. This is just over the next year. This is kind of a summary of during the year, there was a bunch of things that were bought. Now, since the accounting class that we're talking about has a fiscal year end, right, of 12 months. So this is a complete year. It doesn't matter in the sense that if it was 1 month this month, because we're going to have our financial statements prepared and we had this many items that we sold all year long. Now, let's be realistic. They didn't do anything from September during the holiday season. They didn't sell anything. So this is all fake and made up. right? So yeah, the numbers and the dates, but you are right. The dates don't matter when you're doing this. Now, it's okay. So it matters in real life, but it's in the same fiscal year. When we do periodic, again, they'll have assume that all sales were made during the same month or whatever. So again, we're going to make sure that it gets a little bit tricky, but we're going to keep it real simple because I want when you're done with this activity, after we have 5 hours of inventory fun, 2.5 hours this week and 2.5 hours next class meeting, 5 hours of fun. What you're going to say is, hey, I learned one thing that no matter what, I can come up with multiple correct answers depending if I use FIFO or LIFO or average cost. Then I throw in the perpetual versus periodic. There's 5 possible answers for the balance sheet. Another 5 possible answers for the income statement that are correct. Crazy? Yeah, but it works. That's because FIFO is going to be the same. Perpetual, periodic, FIFO is the same. Because I don't know of a situation where it's not the same. It could be, but you'd have to teach me about that. All right, so here's 6.9. This is the weighted average cost one. And so if we come back over to here, it's the same scenario. We have beginning inventory, we have a sale, 2,500, and so we only have 15 left, but we're going to add 45, so 45 and 15 is 6,000. We're going to sell 5 of the 6, right? So we still have 1,000 left, and we buy 2,000 more. So everything's the same, but it's different. Why? Because we're going to use average cost. And every time we have a purchase, we have to calculate a new average cost. You're going to need a calculator to participate. So make sure you have a smile on your face and a good attitude. Get an Excel spreadsheet out because we're going to do some serious math with some serious fun. Not hard math, but we have to do some calculations here. Earlier, we just kind of mostly do it in our head because it wasn't that hard. But anyway, we use weighted average cost. So here we go. The very, very first line is identical. Nothing's changed. Why? Well, because we had 4,000 items at $40 each, 160 grand. No change. And the second one is a sale. No change. We haven't had a purchase, so it's identical because we have not calculated a new average cost because we don't need to. We haven't had a new anything to change. So we're going to sell 25 of the 4,000, and it's $40 each. So this 100 grand means that there is 60 left because out of 160, you sold 100 grand of it. There's 60 left. So these 6 numbers didn't change from FIFO or LIFO just because of the scenario. So I'm ready to have some fun when you are. So I know when you're ready because the thumbs are going to be up on the chat or in the thing. So a lot of thumbs up right now. So it's the stop sign, unmute yourself and say, wait, because if you don't know where we got these numbers, it's going to be kind of a pain. The third item is a purchase. Whenever there's a purchase, we have to calculate a new average cost. And so what does that mean? Well, we're going to buy 4,500. Would you agree with that? So 45 plus the remaining of 15, that means I have 6,000 items. Are you good with 6,000? Because that's good. That's what we need. So I need you to do some math again. Would you please take 4,500 times 44? There's a lot of fours there. 4,500 times 44. Can somebody please calculate that? How much did we have to spend to get 4,500 units at $44 each? Does everyone have 198? That's what we had before, right? So that did not change. But I need to remind you that we had 60 left over, right? Didn't we have 60,000 from the previous transaction left over of inventory? So if you could add 60,000 to this amount, what is the value of my inventory that is left from last time? So 60 plus 119, I'm sorry, 198, getting tired here. So I'm going to claim that there's a 258,000. Does anybody agree with me that we had 60, We just bought 198 more, so I'm gonna add 60 plus 198. I got 258. My brain's getting tired. Yeah, Anna's agreeing with me. So are we okay with that? Yeah, so 198 is right for the first. So would you please take the ending amount of 15 plus this 45 here? Didn't we come up with 6,000? Will you take 6,000 and divide it into 258? So take 258,000 divided by 6,000. Can somebody please calculate that and take 258? So Anna's claiming 43. Do I have an independent confirmation, or are we just going to trust Anna? I mean, she's always been trustworthy, loyal, helpful, friendly, courteous, kind, obedient, cheerful, thrifty, brave, clean, all that kind of qualities that we look and admire. Jacob's going all out because he triple checked himself. I agree, Jacob, you guys nailed it. So let's look over here now. They got this 6,000 because we bought 45 plus 15. That's what we had left over. So there's a 6,000 quantity that we have available to sell. The value of the total cost was 60 plus the new stuff. That's my 258. I took 6,000 and divided it into 258. So okay, 258 divided by 6. That's 43. So I'm going to pause right now. I got a good response from my chat, and I see a lot of smiles in the thumbnail, the Brady Bunch view. So I'm pretty comfortable. There's a lot of you that are comfortable with this, but this is the time for the people that don't have their smile on their face, or they don't have their thumb up in the chat or whatever. I agree with Aaron. He's going to say 43 because he's a smart man. He knows that, okay, everyone else is saying 43 and it is 43. Because just because everyone says up is up, and you hope that up is up, because some people are saying up is down, it seems like. Don't believe them. Because I live in a place called reality. Up is up no matter what. So we say what's up, you can't say what's down. That doesn't make sense. Anyway, so what we have here is that we just purchased. So now we're going to sell 5,000. So when you sell 5,000, we're going to use the average cost. So it's going to be $43 times 5,000. We still have 1,000 left over. So look what happens down here. See, you can see that I have 5,000. I'm not sure why it's being so persnickety on me, but I'm going to outsmart it. So 5,000 times $43. So the total cost of the goods that we just sold is $215,000. If you don't know where we got 215, just take 5 times 43. 5 times 4 is 20. 3 times 5 is 15. There's your 215. What's left over? Well, you just sold 5 grand of the 6, so you only have 1,000 left over. What's the average cost of what we have? $43. So that's $43,000. Again, that's pretty easy, good news. And so I'm going to pause right now to see if you have any questions on that. Because the last one, we're going to buy 2,000 more. So we're going to have to come up with a new average cost. Okay, so we did this math before. 2,000 times 46, that's 92. So 92 plus 43 tells us how much inventory we have. So we come over to here, come down to here. There is my 2,000 times 46 is 92,000. We had 43,000 left over. So if you can add 43,000 plus 92, I'm getting something along the line of 135. Would you agree with that? 135, yep, Anna agrees with it. Casey agrees with it. So take 3,000 and divide it into 135. So you can do it simple by taking 3 divided by 135, or you can put all the zeros in it. Either way, you're going to come up with a new number. Does everyone see where we got 45 bucks here? Because it's math. This number divided into that number. So take 135 divided by 3 grand. So I'm going to pause right now to see if anybody is disagreeing with how we got 3,000, how we got $45, how we got 135. Well, right now, we have to calculate the balances. So we do have to add up the cost of goods sold columns to get 315. But we don't need to add anything because we only have 3,000 left. So it's 3,000 items here and the $45. We just carry these numbers down. So the first two examples, we had different piles of stuff that we had to combine to get a balance. But now we just have a pile that has the average cost of 45 bucks. So you don't have to add, you do have to add the cost of goods sold, but look at this over here. So I'm going to just move this a smidgen over here. And so my inventory right there is going to be 135. And my cost of goods sold is 315. Oh, I forgot the 000 here, sorry. Do you notice that with average cost, it's kind of in between 136 and 132? Welcome back, Anna. Yep, I just noticed that. I just saw it pop back in. So, good assist, Jacob. Thank you. But I let her back in. So I hope it wasn't something I said to offend Anna. She didn't like when I said it was $3,000. It was offensive.
Never, never, never.
Welcome back. But
Thank you.
I got to tell you a funny story here, you guys, that right now, many of you aren't impressed. You're like, okay, average is in the middle. 135 is somewhere between 132 and 136. Yeah. 315 average is between 318 and 314. Yeah. So what? I'm going to tell you right now, there is a book that we used in the 90s, and the author was hilarious. He was a crazy accountant. He constructed a problem where the average cost was not in the middle. He was trying to drive home a point that there could be theoretically a weird situation where the average cost is going to be higher or lower depending upon. So he constructed a problem that's probably not real life, but it was funny because he was trying to drive home a point. This author didn't go that route. It's going to be in the middle. In fact, it's probably been 25 years since we had that book. I don't think it was. I think I got a kick out of it just because I like that kind of stuff. But the point is that most of the time you're not surprised that the average cost is in the middle. You are surprised when it's not in the middle, but then you have to make sure, why is it in the middle? So, now, I'm going to pause right now because, number one, I'm feeling pretty confident that many of you have a good understanding of this. But we have time right now to decide if you need special interpretation or clarification or something else like that, because if you feel that you got your educational dollar tonight and you learn, I mean, if you were to count how many things I taught today, whether I had 30 new items or 50 new items, the question is, how did you do? I thought I explained 50 new concepts: FIFO, LIFO, average cost, ending inventory, all these things that we were kind of throwing around. So did you learn at least, what, a dozen new things that you did not know 2 hours ago? Raise your thumb if you feel like you've learned a few things that you had no clue about until today. So that is a good sign that I see lots of thumbs up popping up right now that education is happening. That means you're doing your part. I can do my part, but it doesn't matter unless you do your part. So I think teamwork makes the dream work. Okay. So I think if we learned 11 new things, that's great. Good job. 15. We can take a short break until, how about Tuesday at 7 o'clock? Oh, wait, before you tune out, double check. Remember, we've got a test a week from today. So let me make this big so as a final reminder. Again, if you're watching this at a different time, this might be a different year. There's going to be a test, but the dates have changed to protect the innocent. But here we are on the 4th. We're going to have a test a week from today, whatever day it is. It's going to be multiple choice 5 and 6. You better be prepared because there's only 20 questions, 10 from chapter 5, 10 from chapter 6, and then 10 will be from 7 and 8 and 9. That's in a couple of weeks. So you don't have to worry about that yet. But it won't take that long because it's only 20 questions. And then we're going to finish the class by starting chapter 7. So we'll have another 2 hours of fun here. So I'm going to pause right now. Yeah, in the multiple choice that you saw earlier, for the chapters 1, chapter 2, and chapter 3, and chapter 4, I keep that same thing. There's very few calculations, if any, for the multiple choice. I save the calculations for the problem test. How'd that sound, Aaron? Do you understand what I'm trying to say? All right. Well, I think you guys have done a fantastic job. I want to commend you. I know many of you are juggling lots of things, whether you're a parent and an employee and a student. That is impressive. I shared that with my wife at dinner. I said, man, I'm so impressed with these people that are working so hard. Yeah, my wife and I were students, and then we got married, and then we had kids. I wasn't trying to be a student and a teacher and a and a dad. So my hat goes off to each and every one of you that are feeling the power of parenthood and working and students. That is awesome that you're able to juggle that. So yeah, so give yourself a pat on the back. I want to commend you all. Any questions before I stop the recording? Because again, I think that we can stick around if you have a few questions. Otherwise, if you listen carefully, I'm sure you can hear your pillow calling your name. Maybe, maybe not.